All eyes were focused on Europe in April, ahead of the presidential election in France. Election polls proved eventually to be reliable, and the victory of Emmanuel Macron over Marine Le Pen led to a rally in risk assets in Europe, both equity and high-yield credit. In parallel, the euro appreciated against the USD as Frexit fears receded and the US economy appeared to slow down over the recent weeks. This market environment led to contrasting outcomes for hedge fund strategies. The Lyxor Hedge Fund index was slightly down in April on the back of negative returns by CTA and Global Macro strategies. CTAs and Global Macro were hampered by a short position on European currencies versus the USD, and trend followers were impacted negatively by the announcement of general elections in the UK, which translated into trend reversals across UK assets. On a positive note, long-short equity, fixed income arbitrage, and event-driven all experienced positive returns in April. In particular, event-driven strategies outperformed, up 2% in April and 4.2% year-to-date as of early May, on the back of stronger positions on cyclical sectors such as financials and materials. Within event-driven, merger arbitrage outperformed recently on the back of positions on companies such as Alere, Actelion, NXP Semiconductors, and Syngenta. Going forward, we have a preference for long-short equity and event strategies over CTA and Global Macro. Stock pickers should benefit from the lower correlation between stock and sector returns in the US and in Europe. Meanwhile, trend-following conditions remain constrained by the lack of firm trends across asset classes. And within Global Macro, we have a preference for diversified multi-asset managers compared to foreign exchange and fixed income specialists. Expectations of higher bond yields and dollar appreciation are less straightforward in the context where the optimism that followed the US election is less significant at present.